If you believe in this idea of infinite variance or a lot of variance, a lot of volatility in the markets, and you hear a lot about in the financial news and stuff like that, then maybe you want to take advantage of that. And there are multiple ways to do that.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome back to the Two Traders Podcast. Walter here. Darren's on the line. How are you today, Darren?
Really good, Walter. Nice to see you again.
Well, guess what, Darren? We're going to talk about this idea of infinite variance. And what does infinite variance mean to traders? Any ideas, or do you want me to take a crack at it, or do you want to go first?
I'd like to hear your opinion on this first, because obviously it's going to be slightly different to mine.
Sure. Okay, so the idea basically comes from one of my trading heroes who's in the Market Wizards book, William Eckhard. And William Eckhard, I believe he was doing a mathematics degree and then bailed out because his buddy Richard Dennis got him into trend trading, basically. But there's actually some really good experiments that you can run yourself in his interview in the Market Wizards, and I've done them. And so basically this is what he says. This brings up two different ideas, okay? There's a variance from your win rate as a trader and your trading system, and then there's a variance in the markets. Okay, there's two different ideas here. So the first idea, which he nails in his interview, is that let's say that you've got a 50% win rate for your trading system. So one way to see that is you could call on and this is just like a mind experiment or like a concrete way of seeing this, is to pull up a spreadsheet and you can have a random sequence of zeros and ones print in the spreadsheet, right? So 0 is a loser, 1 is a winner. And if the probability of a 0-1 is 0.5, then it's a 50% win rate. Now what you'll notice, if you scroll down there and if you keep tabs on what the win rate is, how many ones are hitting the column, is that it will sometimes get really far away from 50%. It'll come back to 50%, it'll go above, it'll go below, but sometimes it stays away from 50%, and it stays away from 50% for a long, long time. So the question really is, when you think about this, is are you really trading a 50% win rate system, or is it something else? After all, you only have so many trades in you as a trader before you're going to keel over and die. So if you're trading this, quote, 50% win rate system, and over the last 3, 4, 5 years, it's been something other than 50%, for all practical purposes, you're not really trading a 50% win rate system. And the reason why is because there's so much variance in the markets. There's a lot of variance in what we perceive to be the true thing. So we perceive to be the win rate as 50% for our system because our testing has shown that, but we get away from that for a long time. And so that's one thing that he talks about in there. The other thing that is critical and is something that trend followers, those people who are looking to make huge gains by their trades, those people are aware of the fact that we have a few hugely impactful events that happen and they affect the markets, and these events are happening with much more frequency than would be expected if we were to believe that the markets have sort of this bell curve shape of variance. In other words, most of the days are going to move about this much, up or down. Let's say we're talking about the S&P 500. Most days on the S&P 500, it's going to move, less than, 150 points, right? Let's say. So that would be the middle of the bell curve. And then at the far end of the bell curve, sometimes the S&P 500 moves 500 points, and at the other end of the bell curve, sometimes it moves only 5 or 6 points. Right? It doesn't move much at all. And I don't know if those numbers are correct. I'm just using them as an example. But the fact is, if that were true, then if we were to look back through time, we would only see a handful of those days where the market moves a lot and goes really, really far. In most cases, when you're talking about stocks, it's where the market falls. Okay, so for example, looking back over the last decade, we had things like the tsunami in Japan. We had things like the Franco-Geddon thing of the Swiss National Bank. Right? We've had things like what else? Other kinds of major events like, is Greece going to exit the euro? Chinese stock markets big fall, and then the government makes it illegal for the for the stock market to fall and for you to sell your shares and things like that. So all of these things have happened, and really, if you were to approach this from a bell curve and say this is, the bell curve fits. If the bell curve was to fit, we'd only have like one of these every 500 years. We wouldn't have a handful of them over the last 5 years, right? So this is the sort of idea that there's much more variance in the markets than we would expect. So that's kind of the idea, and I'd love to get your thoughts on this.
Yeah, I'm completely with this guy's opinions about it. I mean, it's why I don't like relying on figures, especially from back testing and system testing, because, like you say, whatever you tested in a previous period could vary dramatically in the next period for so many reasons, and really the only figures that matter are the ones that are in your account balance. The trades you've actually taken, they're the ones that matter. That win rate is the one that matters, and I think you should always have this mindset. However well you've been trading with your system, it can vary. Even just like a slight variance in the movements of the market, completely alter your figures going forward. So you kind of have to be flexible, I suppose, really. At the same time, you don't want to be so flexible that every time, you're having a bit of a drawdown or a bit of a lucky run that you vary your system. It's why I've tried to sort of move away from patterns and move towards the sort of logic of what does the market do all of the time, rather than specific key moments of entry and exit. From that's why I just kind of break it down into its simplest form. Price, the market is either moving down or it's moving up. I mean, it can only be doing one of those states. And I try and trade a system that over time will make profit based on just that real simple logic. Yeah, I think it is. The variance is just such little things can throw, the data of your next 100 trades off. Look, trying to account for all of that, you're just chasing your tail and getting nowhere, really. And I think you kind of have to stand. It's so complex. You kind of have to stand back and view it from afar, if you like, and say, right, well, this is how I'm going to attack this thing. And at the same time, I'm not thinking that my figures are going to repeat themselves. I hope that I've got a chance of repeating it, and I know my logic is sound, but at the same time, every trade and every week, I'm expecting the unexpected.
Yeah, so as a trader, do you have something in your system that takes advantage of infinite variance? So if we really truly have infinite variance and that the markets can really go much further than we would expect, given a normal distribution of market moves, then how do you take advantage of that? I mean, I know how the way that the trend followers do so is they don't have profit target, right? So if you don't have a profit target, in theory, your trade could go to the moon. It could, as long as it keeps going, you're happy, because you're not going to get out until you have some sort of, reversal signal or, enough of a return against your trade to pop you out and get you out of that trailing exit. So I guess that's my question is, as a trader, what do we do to take advantage of, if we believe this to be true, then what do we do for this?
Personally, I like the idea of not having exit rules, because as soon as you define exit rules, then you can never capitalize on those movements that, like you say, just go on and on. I have very strict rules about entry, and there's no discretion on them. And then when it comes to exit, I'm just looking at it as, is the profit there or is the risk on the table? And I'm just managing those two sides of the coin. Okay, so if, for example, I have 3 short positions and price is looking like it's turning around, well, I've got 3 exposed positions there and 3 lots of profit. So, then I'll sort of say, well, it makes sense to rationally, manage this, either move my stops off or take some off the table. But it's not in a predefined, when A, B and C happens, then you'll do, move your stop or exit. So I really like to have that, and after a while that becomes a comforting way to trade. But initially it's a very difficult concept for people to take on board.
Yeah, this is interesting to me. A trading friend who I work with, and he was telling me how his wife really wanted a new kitchen. Okay, so they wanted to build this dream kitchen in their house, and he was sitting there one morning, and he had this trade on. He trades sort of quickly. He's flat at the end of the day. He's kind of in the lower time frames, and he was sitting in this trade, and he looked at it, and he said, "Well, that's a new kitchen right there." And so he dumped the trade, of course, right? He said, "Well, there's my new kitchen." So he dumped the trade, but the issue was he came back later in the day. He trades in the morning where he lives. He came back later in the day and said, "Wow, I can't believe how much further that trade went after I dumped it because, I had enough for the new kitchen." So I guess if you're using, are there dangers if you're using sort of the bottom line, the profit that's sitting there, if you're using that as a gauge, is that a danger? Or is that just part of the game? You're always going to have those trades where you were happy with the profit and the market keeps going without you and you just miss out on that? Or is there something that, is there some sort of mind trick or something that you do for that?
Well, I mean, going back to your bell curve idea, I think people want to be at the extreme of the bell curves, and why not just sit in the middle and be happy to perform all right, rather than having to eke the absolute maximum amount of pips that were available out of your strategy. I think it's much easier to say, well, what do I need to get out of trading? I mean, obviously some people want to be excellent traders, and they want to always have excellent exits and make as much as possible. But I think most of us really, if we think about it, we've got a clear defined goal, and that can be expressed in money and in pips and percentage account growth. So why not just try and achieve that, rather than thinking, right, well, there'll be an opportunity this week, I need to get the maximum out of that opportunity. I approach it, I'm going into the week, I kind of have a rough weekly target and I want to achieve that, and I know sometimes I stop and I could have made twice as much, and other times I continue trading and give loads of it back. So I think that's always going to be there, kind of regret where you've closed out a trade and it's continued. I think perhaps if you're a technical analysis type of trader, it's probably more difficult because you're obviously looking for particular things to happen that say that your trade is done, reaching a strong support or perhaps some reversal signal. And I think that's probably difficult if everything is saying that price should go down to the next support and resistance. Just taking your profit off there would be very difficult for those sort of traders to do. I use hedging a lot as well, and I'm a big fan of hedging a position. If I was going to go back to support and resistance, if I bought at support and it got to the next resistance where I should take profit and I thought it was going to continue, I just slap a hedge on and wait and see what happens. You've locked in your profit anyway, and that gives you a bit more time to see what the market's going to do. But it's not very popular, and I know in some places you can't even do it. But I'm a big fan of hedging positions.
Yeah, that would be that would make an interesting episode just going down that road. I think that's an interesting one for some people who are interested in that idea or in that practice. So I guess in sum, I would say, if you believe that there's a lot more variance, the markets go much further and are much more drastic in the ups and downs than we would otherwise expect, given traditional statistics, then the easiest way to take advantage of it is to use a trailing exit. It doesn't really matter why you get into your trade. A trailing exit will eventually capture one of those really big moves when you're in a trade. But the trade-off is sort of something you've just touched in this episode, Darren, which is this idea that if you're using a pip target or a percentage target every week, if it's in the middle of the bell curve, it's kind of in the middle of that area that's achievable, you can make that a lot. You can achieve that a lot and feel good about your trading. But if you're using a trailing exit, what typically will happen is you'll have a lot of profit under your belt, and then the market will come back. You'll give back a chunk of that, sometimes a significant chunk of that, before you get out of your trade. And so that's difficult to deal with because Whereas if you have a target and it's an achievable target, you can feel good about what you've done many, many, many weeks. Whereas if you've got a trailing exit and you're using that, sure, you're going to get the occasional really long runner from the tail end of the curve, but you give back profit on every single trade. You're always going to have more profit on every single winning trade, and then you're going to have less profit when the trade is closed by the nature of the trailing exit. So I'm not saying that trailing exits are for everyone, but it's one of those things where if you want to take advantage of a lot of variance in the markets and you see the markets and you think these are very volatile markets, then it makes sense to use a trailing exit. And who says that you have to do one or the other? Some traders are actually very comfortable having profit targets and then leaving some of their position on with a trailing exit. In fact, our good friend Jorge does a lot of that with his trading, right? He tries to capture trends and he has a target, and he also has a position that has a trailing exit. So these are the sorts of things I think that you need to think about as a trader. If you believe in this idea of infinite variance or a lot of variance, a lot of volatility in the markets, and you hear a lot about in the financial news and stuff like that, then maybe you want to take advantage of that. And there are multiple ways to do that.
Yeah. I don't think that a lot of retail traders think there is that variance there, and I think that can often be the problem. And I think that's probably a trick of the eye sort of thing, you know, where you look at a charts and it looks like it looks like the setup that you've seen over and over again, and you know, and so you think you know what the outcome's going to be, and then obviously it does something completely different this time. And if you kind of break it down, really, if there's a certain pattern you're always looking for, you start to kind of visualize just that on the chart. So I think it's something that people should take on board, that there is this infinite variance and there is no best exit and there is no best entry. There's just good enough.
Yeah, exactly. Good enough. You're happy with what you've been able to pull out of the markets, and you got to be happy with that. Yeah, that's it. I mean, to me, the big question is, thinking about exits, the big question is, which of these which of these hurts more? Seeing a trade that you took go on and on and on without you, and you only took a little small piece of that profit that was available on that trade. So does that hurt more, or does it hurt more when you have a whole bunch of profit on trade and then you give some of that or a good chunk of that back and then you get out of your trade? And that's really going to define what type of trader you are. Which of those hurts more? Because if number one hurts more, then you should apply a trailing exit. If the second one hurts more, where you give back a lot of that profit and then get out of the trade, then you shouldn't. You should have targets. You should use something other than a trailing exit, because it's going to hurt too much every single time you take a trade. So it's like most things in life and in trading in general, it's a trade-off, and you've got to decide which side of the fence you want to be on. But yeah, so any closing thoughts?
Yeah, well, I definitely prefer, me personally, I definitely prefer taking a string of losses, knowing that when price moves, I'll get one or two positions in that long move, and I get that big win, clear my losses and make my profit. And when I've tried the other way with the trailing stop, like a sort of stop and reverse strategy, my win rate goes up and I make lots of small wins, but I find that less satisfying, that missing out on the bigger moves. So that's my personal one.
Right. Great. Well, thanks for sharing, Darren, and I'm looking forward to hearing about your thoughts on hedging, because that will be interesting.
Cool. Yeah. See you next time, Walter.
See ya.